First, very few understand what they actually do, how they invest, and where do they get their money. The second one is it is venture capital investments in deep tech, namely 3 or 4 main topics, which is actually the theme of the event. And deep tech is another term which is equally exotic and abstract. It covers many topics, it excludes many, and very few even know what it covers and what it excludes. So it's equally confusing for someone who works in deep tech. Now, if you say venture capital investments in deep tech and deep science, that makes it even more complex. Now, most of the deep tech systems in the recent past, or till recent past, it was essentially about software. But now, you find the deep tech to be in systems. It includes manufacturing. So now you have the perfect storm of venture capital, deep tech, and manufacturing. So to unravel those mysteries and how the investors who run those funds invest in these areas, I have Arjun Rao and Murali here to share their perspectives. But just to warm up the session, to start with, just to get the basics right, let me ask a very simple question to both of them, starting with Arjun Rao. Do you have an investment thesis when you say you are a venture capital fund in deep tech? The same question goes to Murali, but I will let Arjun answer first.
Yeah, thank you, IVK, and lovely to be here on this occasion. And so on the very basics, right? First, I represent Special Invest. We're an early stage VC fund investing in, like IVK said, deep science and tech ideas, right? We've tried to define this in a few ways, right? And take a few parameters that help us identify and narrow down as to say what is deep tech and what sort of companies or what sort of ideas that we prefer to invest in. 2-3 lenses that we take. One is, is there substantial technical insight and complexity in the tech and the product or the platform that an entrepreneur is building, right? The extended way of saying that is there IP? Is it hard to build? Is there some unique insight because of which they've arrived at that opportunity or that problem statement? Usually, not all the time, but usually that derives from a fair few years spent in that technical domain for one or more of the founders that are building that idea, right? Let's take some examples, right? Be it space technology or robotics or semiconductors. Unlikely that the founders would have had different experiences either in academia or in industry, but wake up one day and say either they'll build a satellite or a rocket or they'll build, some new green energy device, etc. So I think founder background, deeply technical, usually deep technical insight on some problem statement that has still not been solved, right? Leading to IP and complexity of building it. And then is that new solution substantially better than anything else that's out there, right? What you want deep tech to be is not incrementally better, but disruptively better. Another lens to take a look at is it 5 times, 10 times, 20 times better as opposed to, 20% better, 40% better, 30% better. So our lens is this is what entails deep tech. It takes some time both on the research side and then on the development side. So R&D, you split into research and development. Research can possibly take much longer and can be done in academia, but D, which is product development post-research, is possibly where commercialization is closer and therefore venture capitalists like us get super interested. So that's sort of the primary lens with which we are looking at companies. They're not business model innovation, they're not go-to-market innovations, they're primary tech product innovations coming from very specific type of entrepreneurs. And that's what our capital is for. Some examples of domains being space technology, climate tech, energy, industrial stuff, semiconductors, biotech, and of course there is AI, robotics, etc. But these are some examples of areas. So that's sort of the lens which we take to say this is what deep tech companies entail and this is where we want to invest.
Only same thing, yeah. And then if you have a different view on how you define that, we could.
Sure. I think the view almost sort of will remain similar, but I will introduce us as a fund also. So in Flexo Ventures, we have been investing in this in the technology domain for the past 10 years. So the way we look at things is that we want a unique value prop in each of the company that we are investing, right? That can be deep tech, that may not be deep tech, right? But eventually what happens is we have done about 25 investments. So in all these investments, eventually what happens is when we are doing an opportunity analysis, the requirement of this unique value prop means that you will sort of gravitate towards harder to build technology, right? And to sort of take off from Arjun's point, so that's what we think what is deep tech, right? So it is a hard to build technology, and that hard to build is, it can be either founders inside, the technological knowledge or the research that is involved, or it is just it's hard to build, right? You have to have a lot of work. Like an example is Gadadhar, who was here in the last panel. That's one company that we have invested in. He's put in 10 years of work before it got actually to the place where he can raise funding from a VC fund like us, right? So it is years of work and supremely hard to build, right? So that's broadly our thesis, right? And to just deep dive on what we look at, one thing is founder product fit, right? If there is a founder pursuing an opportunity, we need to see a fit between what his background is, what his pedigree is, and what is he doing right now, right? If there is no match, I don't think we'll be able to convince ourselves that the founder can pull it off, right? And the second is obviously, while the technology can be deep, right? Does it have a real commercial application 2 years down the line, 3 years down the line, right? We should also note that VCs, I mean, there is often this question asked why VCs don't fund really deep technology. The problem here, or the conundrum here is VCs operate with a finite fund life, right? So, and we need to raise money, deploy it, and return money within that finite fund life, and hence whatever opportunity we are looking at has to be commercially viable in the next 2 or 3 years. Otherwise, it may not make sense for a fund to invest, right? So these are broadly some parameters with which what we look at, right? So that's something that I want to add.
So my second question will be a little more provocative, but I'm going to combine two parts of the question here. The conventional view of venture capital is that they don't fund manufacturing oriented or manufacturing businesses because they don't want to fund inventory or working capital for it. But in most complex systems, which involve deep tech and deep science, you need a finished product to actually make use of it or commercialize it. So the question that often comes up is, while your investment thesis may be deep tech, deep science, do you invest along the value stream of the same technology so that you take it to manufacturing? Or in biotech, I'll pick drug discovery. In space tech, I will pick manufacturing ready one. Maybe in quantum, I'll pick something else. So do you just go by discrete points of interest in each of the deep tech areas, or do you do it along a value stream? So that will be good to know. Yeah, Murali?
Yeah, so, I mean, in our case, I will take an example of Atomberg, right? Atomberg, when we first did Atomberg, it was a deep tech company for us, right? The reason why it was deep tech is, while it is a consumer company today, it was a deep tech company at that point of time because they were innovating on a technology which was not disrupted for the past 30 years. They took a BLDC motor and applied a microchip into it, and that's how they got the power savings, right? So at that point of time, it was the value that is there in a company, right? We think, our view is that it has to be a complete investment, right? You have to go manufacturing also.
Arjun?
Yeah, I'd only add a couple of layers to that in terms of, one, from our stage vantage point, which is super early. Obviously, our focus is not on the inventory part because the company is not yet at that stage where market adoption has already happened, and hence there is need for capital for inventory and working capital, etc. Correct? There will be a stage, hopefully, that when it gets there, but in the beginning, the complexity lies, and just to pick up on the point of manufacturing, it lies in the iteration of the early product, right? How many prototypes do you need? How many subcomponents do you need? How long does that take? What is that supply chain? There is complexity there. You're not at scale, but you have to go through manufacturing partnerships or do it in-house. I think that our view would be nuanced in terms of saying in some cases, it will be very clear that you have to do that manufacturing in-house, right? Because there is no expertise outside. Because you're doing something so different and so unique and so hard that possibly you cannot even find a partner to do the manufacturing aspect, even the prototyping, etc. In that case, you have to then build the machining inside, you have to do the manufacturing aspect and keep both the IP design as well as the manufacturing process in combination as the moat, if you will. Correct? Stage after that, possibly you have market adoption after possibly a few tens of thousands of maybe fans sold by Autumnberg. You need inventory, and I would only kick the can down the road saying maybe that job is for later stage investors or private equity, but that is one. There would be other cases where the tech, you do the tech and the design, but the ecosystem for that particular tech and that particular product, you can possibly find partners outside who will do the manufacturing. And I think it's a case-by-case decision, right, to say
Agreed.
which business should do design and IP themselves, but outsource manufacturing, as long as you get the right partner. And you could still capture value from your design and out licensing perspective. I would take it as a case by case.
Yes.
We have seen both.
Yes. Actually, that's an important nuance that Arjun has added, rightfully so. It depends really on the stage at which we are investing, right? And also in some cases, if it's a semiconductor company, right? Sometimes they'll say, okay, I'll build the product and then sell it off to someone who can actually build the fab, right? That has happened in one of these cases, one of the cases that we funded, right? So it really depends case to case and really on the stage at which the fund is coming in. But I mean, if you want an absolute, I would like to sort of travel the full journey, right?
I think the full value capture is 100%
Yeah.
true if you can do everything,
Yeah.
right? But you need capital at different stages and different quantums of capital. One has to, given the 10-year time limit, which Murli previously pointed out. Fund 2, of course, earlier. We are hoping to launch another new fund in this year, sometime this year.
Murli? So, actually, just to go a little bit deeper into our thesis, right? So, our thesis has always been that if strong IP is built, right, and it is shown that it can be commercialized, there is always an exit possible, right? So, that's been the reason why we have also delved into this space, right? And fortunately, we have also been successful in sort of getting exits for the deep IP companies, right? Ceredin Semiconductors is one company where we exited it to Renesas, right? So that is one exit that we have in a deep tech company. And there are 3-4 other exits that we have seen from our first fund, right? So timelines are similar between both our funds, right? So we have also managed to sort of exit our first fund completely, right? So it's a full portfolio exit wherein we returned all the money to our LPs, right? So and decent IRR to them. So point here is that yes, there is a market for deep tech funds. They can be sort of monetized, and a good IRR is definitely possible for investors. Yeah.
I'd only add one layer to say, irrespective of deep tech or non-deep tech, right? If we look at the data, we will see that companies get to sufficient scale, IPO, etc. The best ones, of course. Somewhere along the way, you can get M&A for either IP or some other strategic reason. But the best companies, as they are growing and building and generally get to IPO, nothing happens in 7-8 years, irrespective of deep tech or not deep tech, by the way, right? It does take 10 years, 12 years, etc. Enough data out there to suggest that, right? Our early stage fund investors and later stage, we may not have beyond 8 to 10 years, right? So we will pass on the baton to later stage investors and extract whatever value we can because we came in early and do that. And then, the Series A, B, or C investors can take it on, right? And then they can extract much more value at the later stage post-IPO, etc. But I am only trying to make the limited point that deep tech necessarily does not mean To build a successful company, it's going to take longer. I think the difference is in how much value appreciation happens in the first 5 years. It is slightly slower in the first 5 years value appreciation for deep tech because it takes time to build complex tech, right? While in, let's say, consumer tech-enabled basic businesses, right? You start building a product, you launch something in 6 months, you start getting revenue, and every year you start seeing some uptick, right? That is the nuance here, right? Overall, I feel all companies take 10, 12 years if you take, let's say, IPO is the goal, correct? Nothing short of 10, 12 years anyway.
So there is since you brought up that point, there is a popular policy debate whether there should be perpetual funds or not tenured funds for deep tech and deep science. Because the time you actually make money from when it wants to mature is generally beyond 10, whereas in a tenured fund, you have to stop it at 10. So there is a debate that is the fund structure limiting your value capture? It's an impromptu question from my side because there's often the debate. There is a debate that the perpetual fund should come from government and not from private, but that's a different topic. But I think a perpetual fund or a longer time frame, will it make a difference for your IRR and hurdle rate and stuff like that?
Yeah, I think, first of all, when it is private capital, right, we also, raise capital from private investors. Some are institutional, which could be partially government or quasi-government or government directly. But otherwise, there's a lot of HNIs, family offices. There's a lot of private capital, right? And private capital does come with time horizons, right? IRRs, liquidity cycles, etc. Does longer time horizons or fund cycles give you some flexibility? I think the answer is, of course, yes. Is it easy to pull that off and convince all your stakeholders to give you substantially longer time horizons? Not so easy. I think we've all observed in the last 5 years or more that there have been funds that used to be 7, 8 years, have now gone to 10 years. Some are talking about 12 years, right? But, it does, the balancing of needing liquidity, right? IRRs can be better, but if IRRs are illiquid, what are you going to do with it? So cycle of money keeping repeating is super critical. Is there value to it? I would also genuinely make the fact that at different stages of a company and of a growth of a company, you need different types of investors, right? Let's say I'm the pre-seed seed investor, right? I may not be the best investor to take that company IPO, right? But I may be very value accretive when an idea has to be taken to market and the early team has to be built, etc. Right? So I think different stages need different nature of investors. Longer time horizons can help, but I think it's okay. 10 years is not bad a time horizon.
I have always been thinking about this, why not perpetual, right? So this is sort of me stargazing or daydreaming about future VC, how does it look in India? But I do agree with what Arjun said, that I think so VC ecosystem right now in India is still just beginning to take off, right? So we have to, so it is good to have timelines right now, because that timelines will push us as investors and entrepreneurs also to push towards target, right? If there is no time, something that takes probably 5 days will be done after 1 month, right? So just give an example. So that you can extrapolate that example to what the startup can achieve. So right now, at this juncture where we are in the Indian ecosystem and where we are just beginning to take off the deep tech journey, right? But 10 years later, I definitely dream that, we can devise a system wherein you can offer exits to LPs periodically, right? But the fund continues to remain in existence perpetually, right? That's something that probably will evolve, but at least you can say that's my dream, right?
So let me now shift the gears and maybe ask 2 questions which are quite political, but they are from a promoter's perspective. So if someone is trying to raise money from a venture capital, there are 2 questions you normally get. If they see government as an investor or not investor, as a customer or the main customer, private capital has some reluctance to invest in such ventures. The second irritation is normally if you have a large corporate, especially the lead integrator in a system, investing in you, they are a bit reluctant because there is no price discovery possible then. So these are the two issues which bother or keep people awake at night if you are a promoter. As an investor, as a VC fund person, what is your reaction to these two?
So again, this is a nuanced sort of question, right? So I'll take the second question first, which is the corporate investor. So a lot of times in deep tech companies, right, which is very hard to build, right? So we also need to have, as an investor, we also need to have a view on how we are going to exit this company, right? So having a corporate investor who's aligned with the interests of the company may actually give you, while I do agree that the outcome may be capped, right? That's a real worry. But it is so deep tech that was, as in 5 years later, who's going to give me exit, right? So having this guy on the cap table, even for a small percentage, may be advantageous for the company, right? And maybe advantageous for us. But each opportunity is different, so it has to be viewed opportunistically, depending on what you're investing in, right? So that's my thought on the second question. On the first question, yes, we are definitely wary of government as a client, but it's not like we will stop investing, right? So again, it depends on which segment of the government, right? If it is space tech, I may be willing, right? But if it is a municipal sort of local body, maybe not. I'm not saying I will not do it, but these are different sets of segments of government which will be paying for the startup, and that is my view, right? So ultimately, who's the client? Does he have the paying capacity? And do I need to jump through hoops to get that contract, right? And hoops can be multiple hoops. Right? That's
Arjun?
Yeah, I think on the government side, I would just add to say, the reluctance is not because the government is the buyer. I feel the reluctance is because, when government is the buyer, it possibly translates into lumpier revenue, right? Which could be one-off revenue. Is it recurring? Is it predictable? Does it get paid on time? Correct? I think any investor is looking for predictability of cash flows and growth rates, etc., right? I think it is that nuance which possibly puts the government as a customer into let's ask that question, right? Government will give 100 crore order 1 year, but is it recurring? Will it come next year also? Will it come 3 years later? And that lack of predictability or uncertainty is possibly where that discomfort may arise from. If we are able to solve that problem, and then the timeliness of the payments, right, which is cash for the company, which is basically, leads to the business health overall and the margins and obviously, free cash flow, etc. If we are able to solve that problem, then just the tag of the government itself is not a problem. Correct? So we should take that lens, number one. I think in some categories, right, yeah. On the second one, on the corporate side, I think Murli mentioned you got to weigh the trade-offs, right? What are they bringing to the table? Right, in terms of strategic advantage that you otherwise will, maybe if you have to do it yourself, you will need a lot more money or you will need a lot more time. But given you get a strategic partner who brings in capital and comes on the cap table, you really fast track that piece of development or that progress. If that positive should override the possible negative or of capping an upside, correct? The other way to look at it is, hey, strategic can come on board, but still leaves the opportunity for the company to still sell to somebody else, still partner with, if you have exclusivity, things like that. Those are the things, again, underlying business, if it starts hitting, then, and the trade-off doesn't make sense that they're bringing value, but they're taking away a lot more. They have too much control on what has to be done in the future. I think those trade-offs have to be looked at closely, and then strategic makes sense. I think a lot of industries, and now obviously there are CVCs, and in particularly we spoke about manufacturing and all the deep tech sectors, strategics are inevitable. Stage might be different, and their value might be different. It may have to be played out tactically, but there's definite value. Indian corporates, global corporates, strategics, immense value for our entire ecosystem.
So I want to ask one last question before I let both of you share your experience for the audience on what are your suggestions or views, especially for those people who are in a startup journey. But my question before we go there, do you have any softer dimension in your fund? For example, in social impact funds, they have an impact dimension. Is there any nation building dimension or, something like that in your funds in addition to the financial returns?
Yeah, again, at the outset, private capital, we are responsible, fiduciary responsibility for private capital. Return on investment is absolutely at the heart and core of what we do, right? We'll set that as stage. Having said that, when we decide deep tech as our core strategy for the fund and as our thesis, inherently we are also putting a layer of how is this helping, this capability building, helping the nation in self-sufficiency, in building towards a more developed nation in the next 10, 20 years, 30 years, right? Is policy going to be positive towards it, right? So on the softer side, we will take a view that these technologies should be doing good for the society, for the industry, and therefore for the country. Do we take that as an offset for IRR? I would say not necessarily, right? We would say that necessarily may not be our role to play, but we are taking the lens that, hey, we want to support manufacturing-led startups, we want to support space tech, we want to support, right? These are critical to the country. And we look at, you take a 10-year horizon, 20-year horizon, these are critical, therefore there will be a tailwind. Overall, it is good for the nation. That's our desire, that's our hope, right? But I don't think it will conflict or it will overlay on IRR. I don't think our investors will say, give us 40% IRR instead of 50% IRR if you do this good thing. Unlikely. As long as we're not doing something bad, I think we'll happy.
I completely agree with Arjun. So we are private funds and we are evaluated on the bottom line is the returns, right? So the IRRs that we generate or the multiples that we generate. So all private funds will I mean, nation building, while it's I would say an ancillary to what we are doing, but not the main objective. But I will say this, right? So the reason why we are in India is the ambition that we see in the Indian entrepreneurs today, right? And there are many, many startups that I come across on a daily basis, right, who are doing things that we couldn't even imagine, right? So there is one medical device company that we funded recently, which does dialysis for liver, right? That guy clearly, and those guys are all 50-plus-year-olds, right? And at that age to come and build something so deep tech, it's talking something about what we have as a nation, right? We want to prove ourselves to the world that, boss, we are not a third world country, right? So that's what I am, as an investor, personally very passionate about. So I'm supporting Indian entrepreneurs who are making a statement to the world that these things can be built out of India, right? And that's where we are sort of helping them, helping the brand image of the nation, right? So that's how I would see that.
I don't know how much time we have, but do you have time for Q&A? One or two questions? Two questions? Any question from audience?
You can just put your hand up. We'll make sure mic reaches you.
The lights we cannot see actually.
Yeah, thank you very much. My name is Venkatesh. I am an entrepreneur, rather I have a startup in medtech, and I am more than 50 years old. So that's one thing. But having said that, I want to know that while some of you have made, both of you have made some allusion to the deep tech and med tech. But are there any specific things on med tech why it is not so easily funded or not so easily understood or accepted when compared to any other this one? I have one follow-up question on that. That when you say that early stage deep science or deep tech companies are there, most of them have come back to me and some of my other colleagues and said that you find a co-investing company and then we will invest. So is that the thesis of a early stage fund? So, or am I missing something?
Yeah, I'll on the medtech side, again, candidly, we've not done many investments. Maybe, and here's my hypothesis, and maybe Murli can add based on experience. There are two aspects. One is medtech, whether it is devices or diagnostics or anything else. Is it for the Indian market? Is it for the global markets? Right? I think one of the questions that investors possibly grapple with, right, me included, would be, hey, if you're building for the Indian market, while the numbers seem large in terms of consumption, right, is there budgets, right? What is the per unit value, right? Let's say whether it's for a medical device, whether it is for a diagnostic test or some other thing, right? So I think the ability to pay may be one challenge in the Indian market. Right? We are getting better, but it might be something that thwarts, investors to say, hey, this may not be a very large market, or you have to literally get to 100 million users and then you can start making money, right? As opposed to if you have 5 million users, you still only make a lot of money, right? On the flip side, you say you're building something for the global markets, then people talk about regulation because you have to go through many hoops to get FDA regulation and to get all the certifications needed, and that needs time, money. I think that piece we have done a lot better because many companies have, solved that problem over the years. So there's more know-how available in our local ecosystem of how to go global by building a high-quality medical product. Correct? So I think these are two nuances. Going global has been hard because it needs time and capital. Domestically, I think the question is what is the per unit value? Correct? That's my hypothesis here. We've also maybe grappled with that and therefore not done enough on the ITech side. Hopefully the markets are changing and the entrepreneurs are getting better and better like yourselves, right? I think the second part was about co-investing, etc. Yeah, honestly, I think both of us are lead investors. I think we can call ourselves conviction-led. We first say yes, then others can join the round, etc. We are not waiting for anybody else to say we want to invest. Maybe sometimes it depends on size of fund, etc. That some funds can take the choice that somebody else leads, we will follow, correct? But, there are enough lead investor funds out there, right, that will take the first decision and say yes, irrespective of who else is coming.
Yeah, just on the medtech aspect, right? So, I mean, what at least we have observed is that one, medicine as a field is very slow acceptors of innovation. Right, that's been our observation, right? So that means that it takes that much more time to actually scale whatever we are doing, right? So they're very careful because it obviously, they have an established science, and doctors generally don't want to move away from that science because they are taking a risk on patient's life, right? So that's generally our observation, why we are careful about medtech funding. And the second reason is, again, a related reason, for us, doctors need to accept this product, right? So the second question is whether doctor will use this product or not, right? So if we don't get the feedback from the doctors that, we are okay, we are using this product, that also has a effect on the decision making, right? So those are two more reasons in addition to what Arjun has mentioned in the past.
Sorry, we cannot take, can we do it offline? Yeah. Are we done? Yeah, I think time is up, so we have to close it. Thank you for your cooperation, and we'll take it offline. Yeah, thank you.
I'd like to request all of you to please give them a big round of applause once again. I'd like to request Rahul Mathur, co-chair of VentuRISE, to present our moderator and two speakers with a token of our appreciation. We'd like to take this opportunity to once again thank Vijay Kumar Ivaturi for moderating that session. We'd like to thank both Murli Krishna Kunturu and Arjun Rao, our two speakers for that session, a brilliant session on the topic Understanding Investment Dynamics and Current Market Opportunities.